Welcome back to the Pro Ticker Podcast,
Your Friday morning edition.
covering major financial magazine headlines.
Everyone.
Feels like we're getting bombarded with news from every direction this week.
Yeah.
Markets are fluctuating,
Lots of political drama unfolding.
and even whispers of a K-pop bubble.
About to burst.
It's enough to make your head spin.
It's true. There's a lot to unpack.
Right.
But that's what we're here for.
Yeah.
To dive deep into the most important financial news.
Help make sense of it all.
Exactly.
So buckle up,
Okay.
because we're going to explore how seemingly unrelated events, from the U.S. elections to those geopolitical tensions in the Middle East and even the popularity of K-pop, can actually ripple through the global financial system in unexpected ways.
It's all about understanding those connections.
Right.
The hidden threads
Okay.
that tie seemingly disparate events together.
Yeah.
That's what makes the financial world so fascinating.
And sometimes a bit unpredictable.
Absolutely.
All right, let's kick things off with the U.S. markets and the economy.
Okay, sounds good.
First up, we have this intriguing article from Barron's that's making a bold prediction about Alphabet,
Oh, yeah.
Google's parent company.
Right.
They're saying that Alphabet is not only going to survive this AI storm, but could actually see its stock price soared by 50%.
That's a pretty bullish outlook,
Yeah.
especially considering the challenges Alphabet is facing.
Yeah. What are some of those?
Well, you've got the DOJ breathing down their neck with that antitrust lawsuit.
Right.
And then you have these new AI players
Yeah.
like ChatGPT and Perplexity nipping at their heels.
It's a dog-eat-dog world out there in the tech space.
It is.
But what makes Barron's so confident about Alphabet's future?
Well, they're pointing to something called sum of the parts valuation.
Okay, break it down for us.
Basically, it means looking at the individual value of each piece of a massive company like Alphabet. We're talking search, YouTube, cloud computing, Waymo, and all their other ventures.
Okay, so what does sum of the parts mean for Alphabet investors?
Well, some analysts believe that if Google was forced to break up due to the antitrust lawsuit, those individual businesses could actually be worth more on their own than as part of this giant conglomerate. They argue that freed from regulatory burdens and able to focus on their specific markets, these separate entities could really flourish.
It's almost like saying that sometimes being smaller can actually make you stronger.
That's right.
There's one little nugget in the article that I found particularly interesting.
Oh, yeah.
It seems like Google isn't just sitting around watching the AI competition pass them by.
Right.
They've already launched a premium version of their AI search product, and it's got more subscribers than ChatGPT's premium offering.
That's a key point.
Yeah.
It shows that Google is actively innovating and responding to the competitive landscape.
Okay.
They're not going to cede their dominance in the search market without a fight.
Makes you wonder, what will the future of search look like?
It does.
Will we all end up paying for premium AI-powered search experiences?
That's a good question.
Would you?
It's a question worth considering.
Yeah.
What features would make a premium search experience worth the cost for you?
Right.
Would it be about getting more accurate results, personalized recommendations, or maybe even having an AI assistant that can handle tasks directly from the search page?
Yeah.
The possibilities are fascinating.
I could definitely get on board with an AI assistant that can handle all my holiday shopping.
Yeah, for sure.
But let's move on from the digital world and talk about something a little closer to home.
Okay.
The housing market.
Yeah.
The Wall Street Journal is painting a pretty confusing picture for potential home buyers right now.
It's definitely a mixed bag.
Yeah.
Earlier this year, we saw mortgage rates drop,
Okay.
which gave some buyers hope,
Right.
but those rates have rebounded back to around 7%.
Oh, wow.
And that's putting a damper on sales.
So is that why we're on track for the worst year in home sales since 1995?
That's right.
Wow, 1995, that's going back a while.
Yeah.
So what's causing all this volatility in mortgage rates?
There are a few factors at play.
Okay.
The Federal Reserve's recent rate cuts and the possibility of further cuts are definitely influencing things.
Okay.
But there's also a lot of uncertainty in the market about where inflation is headed and how the overall economy will perform in the coming months.
It's like trying to hit a moving target.
Right.
It's no wonder buyers are hesitant.
Yeah.
The Wall Street Journal also mentioned an interesting side effect of that legal settlement over real estate agent commissions.
Oh, yeah.
It seems some buyers are choosing to go it alone and buy homes without an agent,
Interesting.
while some real estate agents are hesitant to show homes without a signed agreement.
It's a fascinating dynamic.
It is.
On the one hand, you have buyers becoming more aware of the costs involved in real estate transactions and trying to save money by cutting out the middleman.
Okay.
But on the other hand, you have real estate agents who are also running businesses and need to protect their time and resources.
It's a delicate dance.
Yeah.
Would you ever consider buying a home without a real estate agent?
Hmm. It's a decision that depends on your individual comfort level with risk and your understanding of the intricacies of the real estate market.
Yeah.
It could save you money, but it also comes with added responsibility.
Absolutely.
No.
Now let's shift gears and talk about a company that's making waves with its, shall we say, unique investments strategy,
Okay.
MicroStrategy.
Yeah, yes.
The Wall Street Journal has an article that delves into the frenzy surrounding their stock,
Okay.
which has become a sort of proxy for Bitcoin investment.
Interesting.
We're talking about a stock that soared over 500% this year.
It's been quite a ride.
It has.
MicroStrategy has essentially gone all in on Bitcoin,
Wow.
holding a massive amount of the cryptocurrency on their balance sheet.
So it's like a turbocharged bet on Bitcoin.
You could say that.
But what about the risks involved?
The risks are substantial.
Right.
Remember, Bitcoin is notoriously volatile.
Yeah,
It can swing wildly in both directions.
it can.
If Bitcoin takes a nosedive, MicroStrategy's stock could plummet even faster.
It's not for the faint of heart, that's for sure.
Definitely not.
But the article highlights some interesting stories of everyday investors who are betting big on MicroStrategy.
Oh, wow.
Some even say it's a more efficient way to gain exposure to Bitcoin than buying it directly.
There's a certain logic to that.
Okay.
Buying MicroStrategy stock gives you exposure to Bitcoin's price movements, but it also comes with the potential benefits of owning a stake in a publicly traded company.
So that makes it easier.
It's a more familiar and perhaps more accessible way for some investors to dip their toes into the cryptocurrency market.
It sounds like a high-risk, high-reward kind of play.
It does.
Is this a savvy investment strategy, a reckless gamble, or something in between?
It's a tough question to answer definitively.
Yeah.
It really depends on your individual risk tolerance, your understanding of both the stock market and the cryptocurrency market, and your overall financial goals.
Sure.
It's definitely a decision that requires careful consideration.
Absolutely. Let's move on to the global market and geopolitics now. CNBC is reporting that the Japanese yen has been on a tear, reaching its strongest level in 5 weeks and dipping below 150 against the US dollar.
It's been a notable surge for the yen.
It has.
There are a few things driving this.
Like what?
We're seeing accelerating inflation in Tokyo, which is often seen as a harbinger of nationwide trends in Japan.
Oh.
This is leading to speculation that the Bank of Japan might hike interest rates sooner than expected, possibly as early as December.
And higher interest rates typically attract foreign investment,
That's right.
boosting demand for the yen, right?
Exactly.
Yeah.
On top of that, you have the lingering trade tensions sparked by the recent U.S. elections, which are creating a risk-off environment in global markets.
Yeah.
The yen is often perceived as a safe haven currency, so in times of uncertainty, investors tend to flock to it.
So it's a combination of economic factors and geopolitical anxieties pushing the yen higher.
Yes.
But here's where it gets interesting.
Oh.
Another CNBC article throws a curveball into the mix. One analyst they quoted actually doubts that the Bank of Japan will raise rates in December.
Ah, yes, that contrarian view.
Yeah.
Despite the Tokyo inflation data, this analyst believes the Bank of Japan is more inclined to take a wait-and-see approach.
I see.
They'll likely monitor the impact of the U.S. elections on global trade and the Japanese economy before making any significant policy changes.
So even the experts have different perspectives.
They do.
Speaking of uncertainty, let's talk about oil prices.
Okay.
CNBC is reporting that oil prices are getting whipsawed by conflicting forces right now.
It's like they're on a roller coaster ride.
Yeah.
We recently saw a spike in oil prices triggered by the Israel-Hezbollah conflict and fears of potential supply disruptions in the region.
The Middle East and oil prices,
Yeah.
it's a story as old as time.
As a ceasefire took hold between Israel and Hezbollah, those prices started to ease back a bit.
Okay.
However, they remain highly sensitive to any news of violations or escalations of the conflict.
So things are still very precarious.
They are.
And to add to the uncertainty, we have the delayed OPEC Plus meeting.
Yeah, right.
They're now expected to meet on December 5th instead of December 1st. And nobody seems to know for sure what they'll decide about production levels.
OPEC Plus, which includes heavy hitters like Saudi Arabia and Russia, has been working to manage global oil supplies to stabilize prices.
Okay.
But there are disagreements within the group about the best way to proceed, especially considering the geopolitical tensions in the Middle East and the fragile state of the global economy.
So it's a lot to juggle.
It is.
It makes you wonder how vulnerable we are to sudden shifts in the global energy market. We often take stable oil prices for granted, but they're influenced by so many factors that can change on a dime.
It's a reminder that we live in a complex, interconnected world where events on the other side of the globe can have a direct impact on our lives, our wallets, and our future.
And speaking of complex and
Yeah.
interconnected, let's turn our attention to the Eurozone. The Wall Street Journal is reporting that Eurozone inflation ticked back up to 2.3% in November, which is higher than the European Central Bank's target of 2%.
This complicates matters for the ECB.
How so?
They've been cutting interest rates to try and stimulate economic growth.
Oh.
But this uptick in inflation makes them hesitant to continue down that path.
So they're caught in a dilemma.
Exactly. On the one hand, they want to support growth.
Right.
But on the other hand, they need to keep inflation in check.
The Wall Street Journal article quotes a French central bank governor who suggests they might need to cut rates even further to stimulate growth, despite the inflation risk.
That's a bold stance.
It is.
He believes the risks of a prolonged economic slump outweigh the risks of moderately higher inflation.
It's a high-stakes gamble, and it highlights the difficult decisions central bankers around the world are facing as they try to navigate these uncertain economic waters. Let's turn our attention now to the East, specifically to China. We've got a couple of fascinating articles from Bloomberg that shed some light on the challenges and uncertainties unfolding in the Chinese economy right now.
It's always an intriguing landscape, China. And the first article we have here focuses on a leadership shakeup at China Renaissance, a prominent investment bank that was once a major force in the Chinese tech scene.
China Renaissance. The name rings a bell. Refresh my memory on what they're known for.
They were instrumental in helping many Chinese tech companies go public, acting as a bridge between these innovative startups and the global investment community. But things haven't been smooth sailing for them lately.
What's been going on?
Well, their CEO recently resigned just 10 months after taking over from the company's founder, who mysteriously disappeared last year. Since then, China Renaissance has been struggling, and their stock has plummeted 60% since trading resumed in September.
Mysteriously disappeared. That's not exactly a confidence booster for investors. It sounds like something out of a spy thriller.
It's certainly an unusual situation. And to add another layer of intrigue, the founder's wife was appointed as the new chairperson in October.
Wow, talk about a family affair. It's enough to make anyone wonder about the stability and transparency of the business environment in China. Do you think this whole saga will make foreign investors think twice about putting their money into Chinese companies?
It's definitely raising concerns when you have a high-profile disappearance like that, coupled with a dramatic stock plunge. It's bound to make investors more cautious.
It's a reminder that geopolitical risks and corporate governance issues can really impact a company's fortunes no matter how promising their business model might be.
Absolutely. Transparency and predictability are crucial for attracting and retaining investors, especially in a market as complex and dynamic as China.
Speaking of complex dynamics, our second Bloomberg article dives into China's efforts to manage liquidity in its banking system. It seems they're walking a tightrope with all these local government bond sales going on.
It's a delicate balancing act for sure. China is allowing local governments to sell more bonds to tackle their mounting debt. This puts pressure on banks to purchase those bonds, which ties up their capital.
So it's like a financial tug-of-war. On one side, you have the government trying to manage its debt burden, and on the other side, you have the need to keep the economy humming along.
Exactly. And the article suggests that the People's Bank of China, the country's central bank, might need to take further steps to prevent a liquidity squeeze in the banking system in the coming months. They might have to cut reserve requirements for banks, which would free up more capital for lending.
It sounds like they're trying to thread a needle. They need to support economic growth without letting inflation spiral out of control, all while managing a massive debt load. That's a lot to
Yeah.
juggle.
It certainly is, and it highlights how intertwined China's economic health is with the global financial system. What happens in China doesn't stay in China. It can have ripple effects across the world.
It's like those butterfly wings causing a hurricane on the other side of the planet. We might not be directly invested in Chinese bonds, but their actions can still impact our wallets.
Precisely, China is a major player in the global economy, and their policy decisions can influence everything from commodity prices to interest rates to the value of our own currencies.
It's a reminder that we can't afford to ignore what's happening in other parts of the world. Global events have a way of finding their way back to our doorstep one way or another.
It's all about understanding those connections, those seemingly invisible threads that tie us together in this intricate web of finance and geopolitics.
It's amazing to see how everything we've discussed today.
From Alphabet's AI ambitions to the yen's surge and even China's economic maneuvering,
Yeah. It's all part of this intricate global puzzle.
it really highlights the interconnectedness of the world,
Right.
especially when it comes to finance.
Yeah.
What might seem like an isolated event in one corner of the globe
Yeah.
can send ripples across markets and economies far and wide.
We started by talking about Google navigating the AI landscape,
Hmm?
and now we're discussing currency fluctuations and potential trade wars.
It's true.
It's like a financial domino effect.
It underscores why staying informed and understanding these global forces is so crucial.
Yeah.
It can help us make more informed decisions,
Right.
both in our lives and with our investments.
Remember earlier we were talking about the popularity of K-pop bands and their impact on stock prices?
Oh, yeah.
Made me think,
Yeah.
what other seemingly unrelated events could have unforeseen consequences for the financial markets?
That's a fascinating question to consider.
Isn't it?
We've already seen how cultural trends can influence the market.
Right.
Imagine a scenario where a major K-pop group suddenly disbands,
Oh, wow.
or a geopolitical event disrupts the global entertainment industry.
Yeah, that would be a big deal.
It could cause a chain reaction impacting not just entertainment companies,
All right.
but also consumer spending, advertising revenue, and even tourism.
So many things are connected.
Precisely. It's a reminder that we need to be aware of these broader trends and connections.
Yeah.
It's not just about reacting to events as they happen,
Okay.
but trying to anticipate potential risks and opportunities by understanding the underlying forces that drive the global economy.
So what's the key takeaway for our listeners today?
Staying informed is more important than ever.
Yeah, I agree.
The world is becoming increasingly complex, and the financial markets reflect that complexity
Yeah.
by understanding how global events, economic trends, and even cultural phenomena can interact.
Yeah.
We can make more informed decisions about our investments and our financial futures.
It's all about connecting the dots, folks. And that's what we strive to do here on the ProTicker podcast every Friday morning. We'll see you all tomorrow morning with new headlines from major financials magazines.